Hello, good day. So our topic for today is trade and other trades receivable. So our learning objectives is to define trade and other trade receivables, to determine its characteristic, to determine the measurement and presentation. So what is accounts receivable? Usually receivable refers to the outstanding invoices a company has or the money client owe the company. So meaning these are when we render our services but payment is due in the future date or in the later date, or are created when a company lets a buyer purchase their goods or services on credit. If you would see nowadays, we would have credit cards. These are considered as our also credit sales if we are the vendor. And these are usually done based on trust and merely within the trading or the activities of the entity. That's why this is classified as our current asset. So example, a sold merchandise on credit for 5,000. Entries would be accounts receivable, debit accounts receivable 5,000 and credit sales 5,000. This is the usual pro forma entries. Next, there are different classifications of receivable. Accounts receivable are amount that the customer owed the company for a normal credit purchases. So normally, accounts receivable pertain to a buyer and seller wherein a transactions were done without payment or the payment is due on a later date. And normally, these are based on trust of the seller and the client. Now, we also have the notes receivable. Notes receivable are amounts owed to the company by customer or others who have signed a formal promissory note or in an acknowledgement of their debts. So normally, when you execute a negotiable instrument promising to pay a client or promising to pay your debtor, your supplier, these are now notes receivable because there are evidence of notes or a promissory note. And other receivables, those that are not classified under accounts receivable, because accounts receivable are normally for our trading activities. Notes receivable could be for trading or other activities. We also have other receivable. These are amount that are not classified as our trading receivable, but don't also have a promissory notes. So these are example of these are wages receivable, um, our receivable to the government agencies for overpayments or for our supplier for overpayments. Okay? So the governing standard under receivable, we have previously it is governed by IAS 39 in 2005. However, nowadays, that IFRS 9 took effect in 2008. It is now governed by our IFRS 9, which is financial instrument. Because if you would see accounts receivable would be able to have the same characteristic of our financial instrument. We would have other slides or other video for that one. Next, measurement. Accounts receivable or receivable of all types are normally reported in the balance sheet at their net realizable value. Take note, these are net because we would deduct allowance for doubtful account or allowance for those account that cannot be collected anymore, which is the amount the company expect to receive in cash. We also have bad debts or uncollectible accounts are recognized when a customer do not pay for items or services purchased. So these are when certain customer become bankrupt. We also have account for uncollectible account or if the account would been past due for more than a year or years. Because take note, accounts receivable are normally current if it falls within our trading activity. If it's not, then it would follow whether it is collectible within 1 year, then it would now be current. If more than, then it would not be non-current. But these are only for non-trade receivables. Next, so bad debts. So bad debts or uncollectible account is the amount of the account receivable that cannot be collected. So these are our assumptions or based on estimates that the account cannot be collected. So there are two methods for the computation of allowance for bad debts. We have the balance sheet method, and this normally include aging of accounts receivable when we measure how long this accounts receivable become overdue or unpaid. It's classified from 0 to 30, 31, and so forth. Then we also have percentage of accounts receivable. So if you would see, these are both balance sheet account because these pertain to our accounts receivable. Hence, the amount being derived is the ending balance of allowance for bad debts. Take note. So meaning what we derive under the balance sheet method is also the balance sheet account. Whereas for income statement method, or for our statement of financial performance method, we have the percentage of sales. And since this is an income statement method, what we derive is an income statement account, which is our bad debts expense. So we normally just multiply that. So take note, those are the different. So the presentations, trade and other trades receivable are presented as one line item in the financial statement net of any allowance for uncollectible account. However, the details of which should be presented in our notes to financial statement or our notes for the disclosure under our trade and other trade receivable. So the reader would be able to know what are the component of our trade and other trade receivable. And it can be presented using a discount or gross method for taking advantage. So take note, the gross and discount method will have a separate discussion because it would intake a lot of entries so that you would see why the most advantageous is the discount method rather than the discount method or the gross method. Okay? Next, receivable management. Normally, the effective receivable management would require control to and protect the assets. So the following are essential control. We have to establish credit policy, maintain an up-to-date record. We also need to use voucher system so that we would not be able to double pay or double collect our client. Accurate billing and some audit would also use confirmation letter. Okay? So if you like this video, kindly subscribe and like our channel. God bless you and keep safe. If you have questions, just comment it below. Thank you.